If you are currently filing taxes while separated, you might assume your only options are joint or the often punitive married filing separately. But a specific IRS provision allows you to file as head of household even if you are married. We explore the strict criteria you need to meet, like the IRS 6-month separation rule, and how this status can preserve thousands of dollars in household income during a transition. If you are the primary provider for your kids and you're worried about tax season adding to your stress, this episode is designed to help you understand your financial choices. Let's get started. Speaking of things that are rarely clean during a breakup, let's talk about the elephant in the room: taxes. If you are going through a separation right now, you're navigating a whole new world of legal fees, two households, and emotional stress. And then tax season looms over the horizon. This brings us to our topic, the hidden pathway, filing as head of household when married. Now, I want you to picture Sarah. Sarah is 42, a professional and the primary earner. She and her husband Michael separated back in May. Michael moved out, but the divorce isn't final yet. They are in that messy gray area, living apart but legally bound. When tax time comes, Sarah, and maybe you too, probably assumes there are only two options. Option A, you play nice and file married filing jointly, which requires a level of cooperation you might not have right now. Or option B, you file married filing separately. Most people default to option B because it feels safer emotionally. But financially, it's often a disaster. Married filing separately versus head of household is not a fair fight. Filing separately usually means a higher tax rate and losing out on critical credits like the child tax credit or the earned income credit. It feels punitive, doesn't it? Like you're paying a penalty for your relationship ending. But here is the safe, simple, sound truth that many people miss. You might not be stuck with those two options. There is a specific provision in the tax code, a hidden pathway known as the Considered Unmarried IRS rule. I know it sounds like a contradiction. How can you be married but considered unmarried? Here is the breakdown. The IRS recognizes that if you are the custodial parent, the one keeping the lights on and the fridge stocked for the kids, you shouldn't be taxed as if you have a partner helping you, because in reality, you don't. This rule allows certain married individuals to file as head of household married taxpayers. Think of this rule as a financial bridge. It spans the gap between the we of marriage and the me of being single. Why does this matter? It's all about the math. If you file married filing separately in 2025, your standard deduction is just $15,750. But if you qualify as head of household under the Considered Unmarried IRS rule, that deduction jumps to $23,625. That is nearly an $8,000 difference in income that the IRS doesn't touch. Plus, you unlock more favorable tax brackets. This is a strategic advantage. It allows you to protect your cash flow when you need it most, during the transition, not after the divorce decree is signed. I want you to pause for a second. Filing taxes, while separated, doesn't have to mean financial defeat. Ask yourself, am I the one paying the mortgage? Did my spouse move out months ago? Am I the main home for the kids? If you're nodding your head, you might be leaving thousands of dollars on the table by checking the wrong box. However, and this is a big however, you can't just decide to do this. The IRS has strict criteria, including the IRS 6-month separation rule and the cost of upkeep test. It is not a loophole. It is a strictly defined legal status. So here is your takeaway for this segment. Don't just accept the default. Review your current marital status and living arrangements to see if you might fall into the considered unmarried category before contacting tax expert. But how do you know for sure if you qualify? Well, it comes down to 4 specific hurdles you have to clear. We call them the 4 vital tests, and if you miss even one, this strategy falls apart. Stay with me because next up, we are going to walk through that compliance checklist step by step to see if you pass the test. To get those better tax rates and that higher standard deduction, you have to go 4 for 4 on these tests. Let's break them down. Test number 1, the separate return requirement. This is the cover charge to get into the club. You simply must file a separate return from your spouse. It doesn't matter if you are legally separated or just living apart informally. You cannot file a joint return. If you file jointly, the rest of these tests don't matter. You have to commit to filing a separate return. Test number 2, the cost of upkeep test. This is where we get into the weeds of your checkbook. You must have paid more than half the cost of keeping up your home for the year. Now, I want you to picture your house. Imagine the physical structure and the basic necessities to keep it running: mortgage interest, property taxes, rent, utilities, repairs, and the food eaten in the home. That is upkeep. Here is where I see people get tripped up. Do not mix up upkeep with personal expenses. If you buy your teenager a new wardrobe for school, pay for their braces, or take them on a vacation to Disney, that is great parenting, but the IRS does not count that as keeping up the home. So, when you're looking at married filing separately versus head of household, you need to make sure your household bills, the lights, the heat, the roof, are primarily paid by you. Test number 3, the dependent child test. Your home must be the main home for your child, stepchild, or foster child for more than half the year. Now, here is a practical insight for my co-parents out there. Maybe you have a legal agreement where your ex claims the child as a dependent for the child tax credit every other year. You might be thinking, Alex, I can't be head of household because I released the exemption to my ex. Actually, you can. There is a custodial parent exception. Even if you signed Form 8332, letting your ex claim the child as a dependent, as long as that child slept in your house for more than 6 months, you still pass the residency test for head of household. You are the one providing the home base. Test number 4, the 6-month separation rule. This is the strictest rule of the bunch. This is the IRS 6-month separation rule. Your spouse must not have lived in your home at any time during the last 6 months of the year. We are talking July 1st through December 31st. Let's apply this to a real-world scenario. Let's say you and your spouse separated in May. You are doing great, but then, in August, the water heater breaks at their new apartment, and they crash on your couch for 3 days while it gets fixed. Guess what? You just failed the test. The IRS views the separation as a deliberate living arrangement. Temporary absences for business or military service don't count as separation, but a spouse sleeping under your roof during that July to December window disqualifies you from being considered unmarried. I want you to reflect on your own situation for a moment. Filing taxes while separated is complicated, so ask yourself, which of these 4 tests poses the biggest documentation challenge for your household? Is it proving the difference between upkeep costs like groceries versus personal expenses like takeout? Or is it proving that your spouse moved out before that critical July 1st deadline? Knowing where your documentation is weak right now gives you time to find those receipts or utility bills before April rolls around. So here is your call to action. Don't just guess. I want you to create a preliminary checklist of your household expenses and your living arrangements. Sit down with your calendar and your bank statements and see if you pass all 4 vital tests. If you can check all 4 boxes, you are on your way to significant tax savings. Up next, we are going to talk about exactly how much savings. We're going to run the numbers on the financial payoff of head of household versus married filing separately. And trust me, the difference in the standard deduction alone is worth sticking around for. Let's look at the numbers because they tell a stark story. First, let's talk about the immediate shield for your income, the standard deduction. If you are looking at the standard deduction for 2025, the gap is massive. If you file married filing separately, you are capped at a deduction of $15,750. But if you qualify as head of household under the Considered Unmarried rule, that deduction jumps up to $23,625. Think about that for a second. That is nearly an $8,000 difference in income that the IRS essentially ignores. For a custodial parent like Sarah or Michael, our listeners who are holding down the fort, paying the mortgage, and feeding the kids, that $8,000 deduction difference could mean keeping enough cash to cover 2 or 3 months of groceries or a semester of tuition. But the benefits go deeper than just the deduction. This leads us to our second point, unlocking critical tax credits. When you file married filing separately, the tax code can feel punitive. It often acts like a locked door, explicitly disallowing some of the most valuable credits available to parents. Specifically, filing separately often disqualifies you from the Earned Income Credit EIC and severely limits the child tax credit and dependent care credit. By filing as head of household, you are essentially unlocking that door. You preserve your access to these custodial parent tax credits. If you are paying for after-school care so you can work, or if you're counting on that child tax credit to balance your budget in April, fighting for HOH status is the only way to ensure those credits don't evaporate. Third, let's analyze the tax rates themselves. It's not just about what you deduct, it's about the percentage the government takes of what's left. When you look at married filing separately versus head of household, the tax brackets for separately are accelerated, meaning you hit higher tax rates at much lower income levels. Head of household offers wider brackets, keeping you in a lower tax percentage for longer. It's the difference between sprinting up a steep hill versus walking up a gradual ramp. And finally, I want to highlight a trap that catches so many separated couples: the forced itemization trap. When you file separately, you and your spouse are legally tethered on deduction choices. If your estranged spouse decides to itemize their deductions, maybe they have high business expenses or significant charitable gifts, you are forced to itemize as well, even if your itemized deductions are zero. You lose the standard deduction entirely. However, if you qualify as considered unmarried by the IRS and file as head of household, you sever that tether. You can take that robust $23,625 standard deduction regardless of what your spouse does on their return. It gives you autonomy back when you need it most. So, I want you to take a moment and reflect. If you are currently the primary provider for your kids, ask yourself, how would accessing that $23,625 standard deduction impact my cash flow right now? Can I really afford the long-term financial cost of losing my child tax credits just because I checked the wrong box? Don't just guess at these numbers. I want you to take action today. Use an online tax calculator, or better yet, sit down with a tax professional to run a side-by-side comparison. Estimate the specific dollar difference between filing separately versus head of household. Seeing that number in black and white is usually all the motivation you need to gather your documentation. Up next, we're going to wrap up this series with the S3 strategy. We'll discuss how to execute this safely, simply, and soundly, ensuring your paperwork is bulletproof so you can file with total confidence. Stay with us. Okay, so we've just crunched the numbers. We've seen the table, and the math is undeniable. The difference between checking the box for married filing separately versus head of household isn't just pennies. It can mean thousands of dollars staying in your bank account to help you run your home. But here is the reality check. You can't just want that tax break, you have to prove you earned it. Navigating the tax code while you're filing taxes while separated can feel like walking a tightrope without a net. That brings us to our core philosophy for this episode, the S3 strategy. We're going to make this execution safe, simple, and sound. Let's start with safe. When I say safe, I'm talking about audit-proofing your life. To legally use the Considered Unmarried IRS rule, you need documentation that stands up to scrutiny. I know you're tired, and I know digging for receipts is the last thing you want to do after a long day at work. But think of this documentation as your financial shield. You need a clear paper trail proving you paid more than half the cost of keeping up the home. That means mortgage statements, property tax records, and grocery bills. If the IRS knocks on the door, you don't want to say, "I think I paid for everything." You want to slap a binder on the table and say, "Here is the proof." That is safety. Next, let's keep it simple. We're going to look at your living situation through what I call the 6-month lens. This is where a lot of people get tripped up on the IRS 6-month separation rule. To qualify as head of household married but separated, your spouse cannot have lived in your home at any time during the last 6 months of the year. That means from July 1st to December 31st. Now, simple doesn't mean easy. It means clear boundaries. You have to distinguish between a temporary absence and a moved-out spouse. If your spouse was gone for 3 months on a business trip or deployed in the military, that is a temporary absence. That doesn't count. But if they moved into an apartment across town, that counts. And here is the strict warning. Listen closely to this one. Cohabitation kills the qualification. If your spouse moved out in June but came back and slept on the couch for 2 nights in August while they were between apartments, you are disqualified. If they stayed in the guest room for Christmas week, disqualified. The rule is absolute. If they lived in the house for even one day between July 1st and December 31st, the considered unmarried status is void, and you're likely stuck with the married filing separately versus head of household debate again. And usually, separately loses. Finally, let's make it sound. This is about financial preservation. The S3 strategy positions head of household status as a both-and solution. It allows you to maintain your legal marital status because maybe you aren't ready for a divorce decree yet, while accessing the tax relief relevant to a solo provider. Think of it this way. You are doing the work of a single parent. You are paying the bills like a single parent. A sound financial plan ensures the tax code treats you like one, preserving your income during this messy transition. So I want you to take a second and reflect. Does your current documentation prove that your spouse moved out before July 1st? And how can you apply this safe, simple, sound framework to organize your financial life right now? Don't leave this to memory. Your peace of mind is worth the paperwork. Here's your takeaway and your homework for today. Mark your calendar with the exact date your spouse moved out and ensure you have utility bills or lease agreements that corroborate this timeline. Get that date in writing. If it was June 30th, you're in the clear. If it was July 2nd, we need to have a different conversation. And that wraps up our deep dive into the often overlooked opportunities within the tax code. Navigating a separation is never easy, but as we've discussed today, filing taxes while separated doesn't have to mean accepting a higher tax bill. We've unpacked the specific requirements of the Considered Unmarried IRS rule, debunking the myth that you are stuck filing married filing separately. As we saw in our comparison of married filing separately versus head of household, the difference in the standard deduction 2025 alone, jumping from roughly $15,000 to over $23,000, can provide the critical cash flow you need right now. However, remember the safe part of our S3 strategy. Qualifying for head of household married status requires strict adherence to the rules. You must have that paper trail ready for the cost of upkeep test, and you need to be absolutely certain about the timeline regarding the IRS 6-month separation rule. If your spouse lived in the home for even one day after July 1st, the strategy changes. Thank you so much for trusting me with your time today. I know this is a heavy topic, but taking control of these details is exactly how you build a secure future. I've put a summary of the 4 vital tests in the show notes, so please review those before you meet with your tax professional. If you found value in this episode, please subscribe and share it with anyone else who might be navigating this difficult, gray area. Until next time, keep your documentation clear, stay empowered, and keep making safe, simple, and sound financial choices. This is Alex, signing off.